Today, upcoming, a soft hard landing or a hard soft landing. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. This is our weekly market update. Well, in a choppy trading session, the indices rose in the morning, then wavered before turning negative. So Wall Street closed lower on Friday after a report of slowing US labour market growth. And so all three major indices posted weekly losses as investors brace for more possible downside surprises, a day after disappointing earnings from Apple. A mixed July jobs report showed fewer than expected job gains in July, but there was an uptick in wages that threatens a re-acceleration in inflation and so more Fed action. Still, the markets are holding the faith on a soft landing for the economy as the Fed tightens, but it might still feel a lot more bumpy than many are expecting. The weekly percentage declines for the S&P and the Nasdaq were the biggest since March, with some investors taking profits after 5 months of gains due to the economic data and disappointing earnings and rising Treasury yields. The Labour Department reported that US employers added 187,000 jobs in July, and data for June additions were revised lower to 185,000 jobs from 209,000 reported previously. Average hourly earnings, though, rose 0.4% in July, unchanged from the previous month. That exceeded expectations and took the year-on-year increase in wages to 4.4%. Apple shares fell 4.8%. That's its biggest daily percentage decline since September the 29th, 2022, and dented the S&P 500 by about 16 points. The day after the iPhone maker forecast a continued slide in sales. While Apple's management is focused on becoming more operationally efficient by cutting costs, the gravity of a changing smartphone market, particularly in developed regions that should continue the rest of 2023, is a headwind for the stock, UBS said in the note. A partial counterweight to Apple for the S&P 500 and Nasdaq was Amazon, though. Its shares rose 8.3% the day after the online retailer issued an upbeat third quarter outlook. Amazon's rise was 11 points positive for the S&P 500. The highlight of the quarter was arguably AWS revenue growth that came in about 2% points better than street expectations, and most importantly, management commentary that pointed towards a rationalization bottom with growth trends that have proved stable through July, Deutsche Bank said in the note. Shares in other big tech companies like Microsoft and Snowflake rose 0.3 and 3.5% respectively after Amazon's cloud business segment beat sales estimates. Those big bellwether companies really have the potential to cause investor jitters, even though overall the trajectory and direction of both the economy and corporate earnings seems to be positive moving into August. On the bond market, the yield on the 10-year US Treasury edged lower in afternoon trading. The yield on the 10-year benchmark dipped after the jobs data, particularly boosting some mega-cap stocks. The 2-year also slipped, but of course it remains in recession inversion territory. There's still a lot of uncertainty around geopolitical issues, Ukraine war, and China issues. Friday's decline was more about investors resetting and positioning for potential downside surprises. The Dow Jones Industrial Average fell 0.34% to 35,065. The S&P 500 lost 0.53% to 4,478. And the Nasdaq Composite dropped 0.36% to 13,909. Carl Icahn-owned investment firm Icahn Enterprises shed 23.3%. The company halved its quarterly payout months after short seller Hindenburg Research accused it of operating a Ponzi-like structure to pay dividends. Fortinet tumbled 25.1% after the cybersecurity firm cut its annual revenue forecast as spending from enterprise clients remained tight amid a turbulent economy. Tupperware brands were added 35% after agreeing to that debt restructuring deal that will help free up about $150 million of cash interest and fees as the container maker continues efforts to turn around its business. It's up over 560% over the past month, following the latest rally, with the bulk of gains coming in July when the stock attracted the attention of meme stock traders. Amgen added 5.5% after it reported a higher quarterly profit on strong sales of its cholesterol, osteoporosis and other drugs. And DraftKings shares rose 5.8% after the sports betting firm raised its fiscal year 2023 revenue outlook. A US congressional examination of Chinese stock holdings in BlackRock funds built on MSCI indices could signal a broader clampdown on US institutional investment in such shares, analysts said, as Washington fears American capital could help Beijing gain military or technological advantages. Relationships between the two countries are at a low point amid friction on issues including Taiwan and the Ukraine war. The Biden administration is weighing new restrictions on outbound private investment in China on top of existing bans on certain technology sales and other trade measures. A US congressional committee said earlier this week that BlackRock, an index provider MSCI, were facilitating investments in companies that Washington has tied to Chinese human rights abuse or its military. The House of Representatives Select Committee on the Chinese Communist Party sent detailed questions about how the Chinese shares came to be included in products like BlackRock's iShares MSCI Emerging Markets Exchange Traded Fund. The committee has also questioned other companies over their China ties, and analysts said more such reviews and increased restrictions on US investing in China shares were likely. I'm telling clients to expect more and stronger actions prohibiting or making it more difficult to invest in China and greater scrutiny of those investments, said Joe Ricci-Dahanu, an attorney who advises institutional investors. As long as all these cross-border tensions are out there, there'll continue to be pressure on US businesses. BlackRock said on Tuesday that it had one of 16 asset managers offering US index funds holding Chinese companies, and it said it complies with all US laws and will engage with the Select Committee. The degree to which Western capital enables authoritarian regimes has long been a simmering issue, intensified by a rush of money into low-cost index funds. For institutional investors, China, as the world's second largest economy, is an important component in international portfolios and indices. Chinese companies, including Tencent and Alibaba, account for about 31% of the MSCI Emerging Markets Index in July. Committee Chair Mike Gallagher said the US companies were not doing anything illegal, but that Congress needed to close loopholes. In an interview on Thursday, Gallagher said he was not calling for a complete cut-off of our economic relations with China, but he said the committee is debating this question of guardrails on outbound capital flows. This committee can make policy recommendations, and a hard line towards China has bipartisan support. Todd Rosenbloh, head of research for financial analysis firm Verify, said while BlackRock and MSCI are the most prominent firms in the index investment space, new laws or regulations that emerge from the probe also would likely apply to competing products such as the Vanguard FTSE Emerging Markets ETF. Vanguard declined to comment. If the end result of this investigation are rules that say that index providers need to exclude certain China-based companies, then those rules would apply to others across the industry, he said. Now turning to oil, like an encore demanded each time OPEC performs, the Saudi cuts gambit rose to the occasion again this week, with the kingdom announcing ahead of the cartel's monthly meeting on Friday that it will drop another 1 million barrels per day from its September production, akin to what it did in July and will repeat this month. US WTI settled up 1.34% at $80.62 a barrel. The session high was $83.23, a peak not seen since early April. For the week, the US crude benchmark rose 2.8%, adding to July's gain of nearly 16%. And London-based Brent crude settled the US trading session up 1.19% at $86.15. The intraday peak for Brent was $86.64, the highest since mid-April. For the week, the global oil benchmark gained about 2% after running up nearly 14% for July. Both of those, of course, are inflationary, if you think about it. The Saudis announced their September production cut on Thursday through an anonymous official at the Energy Ministry in Riyadh, that their Friday's OPEC Plus meeting, held via a Zoom hookup, uneventful. To make it merrier for oil bulls, Russia chirped in on the Saudi announcement on Thursday, saying it would shed 300,000 barrels per day from its exports. But traders expressed little faith in the Russian pledge, given Moscow's relatively low truth score in almost anything. And while the momentum in WTI suggests it could ride up till, say, $86 before serious resistance emerged, the rally could reach exhaustion earlier, according to Sunil Kumar Dixit. WTI has the appearance of an overbought market, although its 4-hour stochastics still have room for upside, with open targets for the 100-day SMA or simple moving average at $85.45 and the middle Bollinger Band at $86.90, said Dixit, who's chief technical strategist at SK Charting. Now, over in Europe, European stocks were higher on Friday, with the DAX index in Germany up 0.37%, the CAC 40 in France up 0.75%, and the FTSE in London up 0.47%. The corporate earnings season continued, with AP Moller Maersk stock falling 1.7% after the shipping giant warned of a steeper decline in global demand for shipping containers by sea this year, prompted by muted economic growth and customers reducing inventories. Crédit Agricole stock rose 4.4% after France's second largest listed bank reported better than expected quarterly earnings, driven by strong insurance and consumer finance performances. Airbus Group stock rose 0.2% after the European aircraft manufacturer deliveries rose 11% in the first 11 months of the year to 381 airplanes. European stocks were also given a minor boost early on Friday on the back of more talk from the Chinese government of additional stimulus measures to boost the second largest economy in the world and a major export market for many of Europe's largest companies. China's top economic committee said in a joint statement on Friday that the government will unlock more measures to boost consumer spending and improve local liquidity, but offered no additional details. Additionally, German factory orders climbed a chunky 7% on the month in June, a much better result than the expected 2% drop, and that was helped by the sharp gains in the aerospace sector. However, excluding these large orders, overall monthly activity would have declined by 2.6% in June, suggesting the overall picture remains very cloudy. French industrial production fell 0.9% in June. That's a very sharp fall from 1.1% growth the prior month. And additionally, gold futures rose 0.48% on Friday to $1,978 an ounce, while the euro-US dollar traded 0.6% higher at 1.1010. Most Asian stocks moved in a tight range on Friday as traders hunkered down before key labour data due later in the day, while Chinese shares rose on those promises of stimulus from the government. Risk-off sentiment persisted after Fitch unexplicitly cut the US sovereign rating earlier this week, which also saw investors lock in profits in markets that had outperformed substantially earlier this year. India and Japan in particular saw a heavy amount of selling this week. Japan's Nikkei 225 fell a bit on Friday and lost over 2% this week, while India's Nifty 50 was also down 1.4% on the week. Chinese stocks, though, rose, with the Shanghai Composite up 0.23% and the Hong Kong Hang Seng up 0.79% on a rebound in heavyweight technology stocks in the light of that promise of more measures to boost consumer spending and improve local liquidity. But of course, there was little concrete detail from the government, and that has soured investor expectations. Business activity data released this week showed that the Chinese economy started the third quarter on a weak note and pointed to little relief after growth slowed substantially in the second quarter. And China's consumers and companies are tying up trillions of yuan in long-dated deposits with banks, effectively taking a vast pool of money out of circulation and risking the kind of liquidity trap that hobbled Japan's economy in the 1990s. Latest official data showed financial institutions issued about 5.5 trillion yuan worth of long-term deposits, known as certificates of deposits. In the first quarter of this year, the largest such quarterly issuance since the product was introduced in 2015. Domestic investors have rushed into those CDs over the past year in a desperate search for returns as they withdrew from real estate and the stock market, both traditional investment options now looking treacherous because of regulatory and economic problems. Companies have joined the scramble this year, adding to the drag on China's economy, as it effectively means both businesses and households are hoarding cash rather than investing it despite low interest rates, a classic liquidity trap that plagued Japan for years beginning in the 1990s. Based on Japan's experience of the 1990s, there is a risk that China is entering a liquidity trap due to the risks of balance sheet recession, said Naxos's chief economist for Asia Pacific, Alicia Garcia Herrero. Analysts see the same lack of confidence in today's Chinese households and companies that Japan grappled with in the 1990s. But in China's case, there is a key difference. There is no deflationary threat yet, nor have banks switched off lending. Fang Gang, a prominent economist and former advisor to the central bank, told a forum in June that China faces a liquidity trap, but not a Japan-style deflationary morass. It's like money falling into a black hole, and that's what we're in right now. Demand from companies and households is not vibrant. Chinese policymakers have cut rates and encouraged banks to lend more in efforts to relieve economic growth after the pandemic. Yet, about 180 domestic A-share companies say in their stock filings that they have invested in CDs this year. A banker handling retail accounts at a state lender said there was higher than usual demand for CDs because who knows if the broad environment could get worse. While some clients had invested in cash products which can be redeemed at any time for urgent use, most have signed up for 3-year CDs with penalties for early withdrawal, which means the money will be locked away for a while. The rush for the safety of CDs and other safer wealth management products undermines policymakers' drive to boost demand and consumption through tax cuts and the relatively restrained property support measures. Byron Gill, manager of the Pacific Opportunities Fund at US-based Indus Capital, also draws parallels with Japan's balance sheet recession during the country's lost decade. What we can say in the case of China is that a sub-segment of the economy, the property sector, is absolutely in the midst of a balance sheet recession, Gill says. And to the extent that property makes up a quarter of China's economic output, it's not a small deal. China has a long history of saving rates being high. According to World Bank estimates, the savings rate to GDP is the highest among large economies. Total household deposits were at a record 132 trillion yuan, which is about 18.41 trillion US dollars. That's equivalent to more than 30 months of retail sales at the end of June, and up by 12 trillion yuan in the first half of this year, the biggest increase in a decade. Certificates of deposit, CDs, are issued by banks and considered one of the safest savings options, with yields of 3-year CDS usually hovering around 3%, higher than those on bank demand deposits. With few signs of a recovery in the property sector and an uncertain job outlook, the accumulation of household deposits suggests widespread pessimism among households, said Betty Wang, senior China economist at ANZ. Now in Australia, Australian shares ended Friday's session higher, but there was a steep sell-off in Mesoblast, Block and ResMed, which capped gains. Healthcare stocks posted the biggest loss, down 1.2%, but a late bounce from tech and energy did offset some of the damage. The S&P ASX 200 edged up 0.19% to 7,325 to post a weekly loss of around 1% after heavier losses midweek, and the All Ords finished up 0.2% at 7,527. Shares in sleep disorder and breathing devices company ResMed tumbled 9.3% to $30.70 in the worst recession in 3 years, after revenues came in slightly below expectations in the fourth quarter of fiscal year 23. Afterpay parent Block slumped despite second quarter earnings beating forecasts and a stronger outlook, with the company calling out Australian spending as being more challenged than the US. Its share price lost 5.8% to 109.51, which was the most since March. And ANZ Bank shares rallied 0.8% to $25.45 as it vowed to continue to fight to buy Suncorp Bank after the competition regulator knocked back its $4.9 billion acquisition on competition concerns. Suncorp were up 0.6% to $14.13. The ACCC sent out a direct message to major banks that they need to prosecute their case better and more clearly, said George Barboras, head of research at K2 Asset Management. This is a good message to the industry that being bigger is great, but you can't be going down the path of moving towards anti-competitive or globalistic pricing power. Elsewhere, shares in technology company Atlassian surged by more than 23% in after-hours trading on Wall Street after it reported better-than-expected full-year results, brushing off concerns of a slowdown in technology spend. Now, of course, the Reserve Bank on Friday cut its near-term growth forecast after the fastest interest rate tightening cycle in decades. In its latest statement on monetary policy, the central bank said it expected gross domestic product to expand by just 0.9% in 2023, down from its previous forecast of 1.2% and below the current rate of 2.3%. That's the lowest rate in 3 decades outside the pandemic, as rising mortgage rates and high taxes batter household budgets. The slump is an inevitable consequence of the most rapid interest rate tightening cycle in a generation, where the RBA is aiming to engineer a return to its inflation target without an unnecessarily sharp jump in unemployment. Growth is predicted to remain low, increasing to just 1.6% in December 2024 and to 2.3% in December 2025, the RBA said in its quarterly statement on monetary policy. The near-term growth downgrade, included in an otherwise little-changed set of forecasts, comes just days after outgoing RBA Governor Philip Lowe announced the cash rate would be left on hold at 4.1% amid signs inflation is easing. That decision led several economists to predict interest rates had reached their peak as markets price a 40% chance of no further rate hikes. The RBA expects headline inflation, currently at 6%, to fall to 4.1% by the end of the year, 3.3% by the end of 2024, and 2.8% by the end of 2025. Nomura's senior economist Andrew Ticehurst said the inflation forecast left the bank little room for error. Any combination of the numerous upside risks that's identified could result in another rate increase, and indeed, we can continue to forecast a final 25 basis point hike in November, reflecting this thinking, he said. It is possible the RBA tightening cycle is over, and we note others coming to this view, but we think it's too soon to reach that conclusion. Given the RBA reason to pause are clear signs, 12 interest rate rises are causing a sharp slowdown in consumer spending. New data on Thursday showed retail spending has entered its most prolonged contraction since the global financial crisis as households cut back on non-essential purchases. The RBA says a small number of large household goods and clothing retailers in its liaison program had reported large falls in sales in recent months. Community services organisation involved with the program reported an increase in calls over the past 6 months, which they attribute to the increasing costs of living. Aside from high rates, the central bank noted the increasing tax burden caused by bracket creep was also weighing on household incomes, which more than offset the wage gains delivered by the tight labour market. The contentious Stage 3 tax cuts will support household incomes and consumption when it comes into effect on July the 1st, 2024, the RBA noted. The package, if it is brought in, will create a single 30% marginal tax rate for taxable incomes between $45,000 and $200,000, and it's been criticised since most of the benefits accrue to high-income earners, given this group pays more income tax. While some economists believe the RBA may hike rates again due to the strength of the labour market, the statement identified several signs that employment was starting to buckle under the weight of high interest rates. This includes a rise in the number of people who have been unemployed for between 4 weeks and 52 weeks, and a recent fall in the share of people changing jobs. The unemployment rate, which has been close to 3.5% for about a year, is expected to inch up to 3.9% by the end of 2023 and to peak at 4.5% in mid-2025, in line with the RBA's previous forecast. And of course, the question here is what assumptions are being made about migration. Migration is expected to continue at a very strong rate. And it's also worth noting that the statement showed the RBA considered increasing the cash rate to 4.35% at its most recent meeting, amid concerns services sector inflation could remain high due to the strength of the jobs market. But the board opted to keep the cash rate on hold due to signs the 4 percentage points of interest rate rises it's delivered since May 2022 are generating the desired economic slowdown. The board is also mindful that the typical lags of monetary policy mean that the full effects of the interest rate increases to date on demand, the labour market and inflation are yet to be seen, the statement said. And the Aussie was up 0.28% on Friday to 65.71 against the US dollar, and down slightly to 51.54 against the English pound. And finally, Bitcoin drifted lower as market concerns over the largest global exchange, Binance, reignited Bitcoin price downside. It was last at 29,051 US dollars. So standing back, here is the conundrum. Markets are still believing that there will be a perfect soft landing. In other words, inflation will come down, the jobs market will stay robust, and households will continue to spend. If all of those things happen, then firms will be able to generate income and revenue, and therefore the markets are pretty much aligned to where they should be. But if any of those wobble, then that soft landing becomes a hard landing. And if there's a hard landing or a recession, then stock markets are significantly overvalued, probably by somewhere between 10 and 30%. So this is the dilemma. Is it going to be a soft landing? A hard landing? Is it going to be a soft hard landing or a hard soft landing? That is the question of the hour. And at the moment, nobody can give you a clear answer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.